Let's just start with this phrase, nervous bulls. What speaks to you in this fund manager survey that tells you that ultimately they're nervous?
Morning. Look, it's great to be back here. Look, nervosity was palpable across some of the key metrics that we look at every month in the Global Fund Manager Survey. Take, for instance, the risk appetite. About a net 23% of FMS investors said that they were taking lower than normal risk levels at the moment. We also have the FMS Financial Market Stability Risk Indicator, which is this blended measure of risk indicators which rose to an 8-month high. You also look, for instance, at the desire for greater payouts. This rose to the highest level since 2013. And finally, just look at the extent of the rotation out of cyclicals and commodities into bond sensitives and defensives. This one was one of the most brutal rotation in the 25 years of the Global Fund Manager Survey. So yes, there is palpable nervosity, and maybe the best illustration of this apparent nervosity is FMS positioning on commodities. FMS investors slashed their exposure to commodities and are now the most underweight the asset class since June 2017. And that's why we say that investors are nervous bull into the fall.
That commodity position speaks to why we've got this biggest underweight on energy since December 2020. Just to sit on the sectors and go through some of the overweights and underweights elsewhere. Overweight utilities by the most since December 2008. The biggest overweight on banks since February 23. The most overweight on staples since September 23. Can you walk me through what's offensive and what's defensive in those sectors? Utilities, I'm told, are defensive by some, but by others they are more offensive given this tie-up with AI more recently. Banks, I don't know if banks are meant to trade higher on higher rates or on lower rates anymore. And then you've got the likes of staples, which typically is very defensive. What does that sector mix, those preferences tell you?
Look, I mean, yeah, you're absolutely right. You know, we decided in this survey that we would consider utilities, staples as the classic defensive sectors. At least these are perceived by our FMS investors base as the defensive sectors. Remember, these are global sectors and not just only US focused. And clearly, when you consider the average net overweight on utilities and staples on one side, and on the other, what you can easily perceive as cyclical materials, energy, but also industrials, this is one of the most rapid month-over-month shift into defensives, led by utilities, as you said, the most overweight utility stock since December 2008. And on the other hand, the shift out of cyclicals was driven by commodity sensitives. But if you also consider tech as a cyclical sector, FMS investors have cut their allocation to tech stocks to only net 3% overweight, which is, by the way, the lowest since April 2023, when we first started to record that long Magnificent Seven as the most crowded trade, which it still is this month.
Elyas, how do people normally look at the Bank of America Fund Manager Survey? Is it a contrarian signal, or is it a leading indicator of where investors are putting their cash?
I think it depends on the category of investors, but most view it as a contrarian survey, because at the the FMS Global Fund Manager Survey is great at building a narrative on sentiment and positioning and seeing how the consensus has evolved. Today, there's clearly been a defensive tilt in positioning through the summer. This is how FMS investors have weathered the summer vol events in July, in August. They have shifted into utilities, but also into bond sensitives, and that's related to the big expectation regarding rate cuts. In fact, we just recorded the biggest share of investors expecting lower short-term rates in the next 12 months. 93% of them expect lower short-term rates by this time next year. And on the other hand, it's great for developing a contrarian view. If you are a contrarian today, you would actually be adding to commodities, to anything that's China sensitive, energy, commodities, but also cyclicals and REITs in particular. So that's how we form the contrarian view.
Yeah, next level contrarian when you start going heavily into China, considering the current sentiment. Another aspect in terms of if you really feel bold, 90% of recipients expect yield curves to steepen. That is the most on record. This comes at a time, exactly to your point, everyone's expecting short-term yields to go lower. How many people are pushing back in any way, shape, or form and expecting a flattening yield curve? Or, I mean, is that something that people are even thinking about, or does this really hint at this concern that maybe there is too much complacency priced in about what the Fed is willing and able to do with rate cuts?
Of course, I mean, if you are very bullish on a global economic soft landing, you are very bullish on the fact that inflation will slow, that central banks will be able to deliver swift easing cycle and rate cuts in the next 12 months. And that's how you position in favor of a steeper yield curve. But the big steepening has happened already. I mean, you discussed that just before our discussion, right? The bond market is pricing, it depends on the day, but between 200 and 250 bips of cuts in the next 12 to 15 months. That's a lot of cuts. And you see why we considered this survey as a nervous optimistic survey, because it's so reliant on Fed cuts. And the big risk is if the Fed does not deliver in terms of expectation, that's where the big risk lies as of today.
Elyas, you mentioned China. How concerned are investors about the macroeconomic outlook coming out of Beijing?
Sure. I mean, we're talking about the world's second largest economy, and FMS macro sentiment on China just hit the lowest level in the past 3 years. In fact, since we started asking about China growth expectation. So China has clearly been one of the major factor in weighing down on the sentiment this month. But the bullishness on the Fed, the bullishness on the soft landing have been able to outweigh the pessimism on China. And that's why the overall FMS sentiment rose for the first time in 3 months. And this whiff of optimism on the other end allowed for lower FMS cash allocation. Investors started to deploy cash for the first time in 4 months. And we think that's a contrarian positive in the near term.